Yeah, it's really interesting, right? I've actually, as part of what we do at Dashdot, we organize portfolio health checks for all of our clients. And as part of that, we do get valuations, and we do get some full valuations. So I've actually read some of these cap rate valuations that have come through just to understand the rationale. And the rationale from the valuer's perspective is that it is perceived as an investor asset. And that's how they, as a result, they use that as the best way to derive a value of that property.
Hello and welcome. You're listening to Dashdot Insider, the home for property investors seeking a life of freedom, choice and abundance. And if you want to know how to make more money, capital, cash flow, build your property portfolio faster, have more fun, and live a life of freedom, choice and abundance, then this is a great episode for you. We talk in this episode about how valuations can be used to solve both capital and cash flow constraints. And boy, oh boy, there is some great hacks in here. Not only do we talk about refinancing and how we can, better do that and the benefits of that, we actually talk about how you can use refinancing to increase your cash flow, specifically on the basis of valuations and the way that you can get those done. We talk about the different types of valuations, when they apply, how you can use them. This is a hackathon when it comes to how you can use valuations as a strategic tool in your portfolio to get more juice out of your portfolio so you can get to everywhere you want to get to in life much, much faster. My guest today is Jason D'Silva. If you haven't seen him on the podcast before, go check out all of his previous episodes. They are all great. But before we get stuck into it, please remember to subscribe on whatever platform you're on and share this with somebody. Share this with somebody who is a property investor who maybe wants to be a property investor that you think is going to benefit from learning valuation stuff that's going to help them to accelerate their portfolio. It's super useful stuff. I'd love it if you could help us get the word out. And without any further ado, let's get stuck right into it, and I'll see you on the inside. Hey guys, welcome back to Dashdot Insider. Joining me today is Jason D'Silva, the top dog of client success at Dashdot. Jason, how are you?
I'm going well, Goose. How are you?
Very well, thanks. I always really enjoy doing podcasts with you because we always cover really interesting stuff. And that's mostly because you're like a complete freaky nerd when it comes to property shit. Is that a fair statement?
I think that's a fair statement. So a lot of what I've seen is a lot of general property concepts, but working with our clients, we've been able to come up with some really creative, and I've never heard things like these being discussed before. So I'm really excited to share some of the things that we're working on in the background. Yeah,
totally. Last time you were on, we covered different ways to increase cash flow in the portfolio. And I know for a fact that helped heaps of people. And if you haven't listened to that episode, by the way, just go back and check it out. And we might link it in the show notes as well. But I know heaps of people who actually took those strategies that you talked about in that podcast, applied it, and then maximized heaps of cash flow in their portfolios. So I'm really excited to see what we're going to dig into today, because the topic of today's discussion is how clients can use, or how investors can use valuations to solve both capital and cash flow constraints, which is a really interesting concept because most people don't think about valuations as something they can use as a tool. They might think about valuations as something that happened maybe as part of the purchasing process. When they apply for finance, there's a valuation done on the property, maybe as part of the selling process, or potentially as a refinance type thing, but usually just as a mechanism to kind of like get some kind of cash out of the property, as opposed to thinking about it as specifically as a strategic tool that can be used in a portfolio. So I really want to get into this, but why don't we start with what are the kind of different types of valuations?
Yeah, for sure. So with the properties that we buy, we see two main types of valuations. So we see desktops or AVM valuations, and those are usually automatically generated valuations. Each of the major banks has their own valuation tool that they use to generate these valuations. They usually pull from data sources like CoreLogic and PropTrack. And essentially it derives an instant value of the property based on that data. So usually it's comparable sales data over 3 to 6 months. And based on what that tool has available, it will essentially produce an automatic value of that property.
Yes. And they are sometimes really advantageous, but often really incorrect. What's your experience with AVMs?
For AVMs, what I've noticed with a lot of our clients is they're really helpful when it's a very common property type and there's lots of comparable sales. But if the property is a little bit obscure, or if it's in an area where there isn't a lot of comparable sales, the valuations can come back really wacko, like sometimes really high and sometimes really low. So it's really important. Like one example is duplexes on one title. Usually when we get desktop valuations for properties like that, they do come back really funny. But if you've got a standalone house that's in an area that has lots of comparable sales, they can usually be pretty accurate and a pretty good indicator of what a property's worth.
Yeah, one of the biggest issues though with desktop valuations is that they're a lagging indicator. Because they use historical 90 days worth of data. So when the market is going up, they tend to undervalue properties. That tends to kind of be broadly the experience. Personally, I had an experience with this myself. I think you remember we were buying a property in New South Wales, and we were dead set clear on the valuation, but that wasn't a value. That actually wasn't an AVM. That was a
full val.
That was a full val. Okay, let's talk about full vals, because we've covered desktops, AVMs. What's a full val?
Yeah, full vals are really interesting, right? So these are the most common vals that people would see when they're buying a property. So this is when the bank essentially instructs a qualified valuation firm to attend the property, complete an inspection, and produce a valuation report based on what they feel the most comparable and advantageous way is to value that specific property. So those can usually take a few days because the bank then has to organize for the valuer to liaise with the property manager or the sales agent, inspect the properties. If there's a property's tenanted, they have to liaise with tenants. They'll go complete a full inspection of the property, and from there produce a valuation report on where they see value. Usually they use two different types of valuation methods when they do that. From what we've seen, they use a comparable approach where they'll look at similar properties in the area that have sold recently and discount them based on the attributes to make sure they're similar to the subject property that's being valued. We also see properties valued on cap rates, which is really interesting. This is more so for our multi-dwelling properties. I can go into a little bit about that, but is there anything specific you want me to cover on the full vals before that?
Yeah, no, well, I guess the full val just at least ties back to the story. So it's really interesting. So on the one hand, you've got desktop vals, which are fundamentally driven by algorithms. That's really the fundamental driver, right? It's just a system. The system, automatically looks up, sales and whatever, and comes up with a number and says, hey, this is what we think the valuation is. Bang, right? So it's quick, but not necessarily accurate. Then you've got full valuations, which a certified or a practicing valuer will actually go out theoretically. I say theoretically, and if anyone wants to hear me poke fun at valuers, just look up a previous episode I did with Ashwin Sinan, who is actually now on the team, hilariously enough. But these valuers are supposed to go to a property and supposed to conduct a full valuation of the property. And so you're supposed to end up with a really accurate measure. My experience, I'd love to know your take on this as well, is that, I don't know, a reasonably high percentage of the time, it does not appear that valuers actually go to the properties to do a full valuation, or at best may do a drive-by and go, okay, that looks like the house, blah, 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 tick a few boxes and off we go. And the example that I've got of that happening is the property we bought in New South Wales, where the valuation came back 30 grand under what we believed market value was, and also what we agreed the contract price was. And then we challenged it, and it came back 30 grand less than that again, which was completely ridiculous. So then we challenged it again and provided a lot of supporting evidence, to which the valuer came back and then gave it a valuation of the contract price. It just goes to show that there's obviously some systemic fallacy there. But what's your experience with full vals?
What I've noticed with full vals is, and this is with valuations in general, is that they're an art, not a science. Usually, what we've seen when we get valuations ordered, and I've got some examples here as well, where we'll order 4 different valuations from 4 different valuers on the same property, and all 4 of those valuations will have a different result. It's quite rare, actually, that the values would come back exactly the same. So it largely depends on how that valuer individually perceives that property and what comparables they use to derive its value. And that's traditionally quite different from other valuers. It's quite rare that we'll see valuers value the same property at the exact same price, which is quite interesting. So I've got some examples around that and some strategies around that that can actually work in clients, in the listeners' favors, actually.
We'll come back to the strategies and the examples because I want to dig into that. But before we do, we mentioned cap rate valuation. So what's a cap rate valuation?
So cap rate valuation is essentially valuing the property based off its gross rent. And this is usually how commercial properties get valued based on gross or net rent. But for residential, we usually see properties getting valued on the gross rent, usually for multi-dwelling properties. These could be duplexes, triplexes, unit blocks, because these are generally perceived to be investor-grade assets, and investors are rational, and they purchase properties based on looking at the numbers and deriving a rational yield of what they're looking to achieve from a return perspective. So a cap rate will look at what is the general yield for that market, and then looking at the the income that the property is producing to derive a value based on that basis.
I think that's actually the rationale. Like, duplexes are more investor stock, therefore we'll use a cap rate valuation. That doesn't seem. Do you think that's genuinely the reason, or do you think
it's a good question?
Yeah, or do you think it's actually more? Yeah, or do you think it's actually more tied to the fact that, there's multiple income streams. Maybe there's, It's interesting to consider when you think about a duplex can be valued using a cap rate method, but also a shopping centre would almost certainly be valued using a cap rate method. But a duplex probably more than likely would use a cap rate method, but not necessarily. And so there's a bit of a bridge between those two, because you can look at if you've got a 4-pack unit block or a 10-pack unit block, you can kind of go, okay, it's sort of like borderline commercial asset. You can kind of understand that a little bit.
Yep.
You go, okay, commercial. But when it's a duplex, I mean, that seems to be on the stretchy end of it. So what's your thinking around that?
Yeah, it's really interesting, right? I've actually, as part of what we do at Dashdot, we organize portfolio health checks for all of our clients. And as part of that, we do get valuations, and we do get some full valuations. So I've actually read some of these cap rate valuations that have come through just to understand the rationale. The rationale from the valuer's perspective is that it is perceived as an investor asset, and that's how they as a result, they use that as the best way to derive a value of that property. We have also seen some of these duplexes getting valued on comparables as well. But, and this is quite interesting, when the cap rate is used, usually the valuation amount is higher.
Interesting.
Yeah.
Interesting. Is that because, broadly speaking, on a duplex, you're sort of getting apartment rents but house rates in effect, right? So an apartments typically have a higher yield per unit, and you've got effectively two apartments basically stuck together in a house kind of general formation. So you sort of got a higher. That's kind of effectively it. And so on that basis, because you're effectively got an apartment yield, you're valuing it on the yield versus what the equivalent would be if you just knocked out the middle wall and had it as a house.
100%. And there's also ways that people can influence the rents on these types of properties as well. So if they're making sure the rent is in line with market value, they will perceive a higher valuation as well when that property does get valued if the cap rate is used. And I've done this in my own portfolio, and some of our clients have done this as well, and it's been really interesting.
Yeah, okay, cool. Let's talk about how we can use these valuations to our advantage, because there's so many cool things. I nearly speared into how people could use rents to then crank up valuations and stuff, but I know you got a few examples. Where do you want to start?
Yeah, so I've had to think about how the listeners can strategically use these valuations to obviously, we've spoken about this previously. There's a few different constraints that people have when growing out their portfolio. Usually it's capital, borrowing capacity, or cash flow. Valuations can be a really good tool for helping to overcome capital and cash flow constraints as well, strangely enough, which we'll go through a little bit later. But in terms of overcoming capital constraints, one of the tips that I have in here is using a broker over a banker. And we've spoken about this a few times, but it's quite advantageous, specifically from a valuation perspective, because brokers have access to usually 30, 40. We have one broker that has access to 150 lenders. They can order valuations through multiple different lenders. And as we spoke about previously, value is an art, not a science. So usually the valuation results can differ quite significantly, and that difference can actually be quite advantageous in terms of being able to have enough equity to roll that property roll into the next property or not. So as an example, we've got an example here of a property that we recently bought in Townsville. We had that valued 4 different times, and the discrepancy between the lowest valuation and the highest valuation is about $65,000.
Yeah, and that's on a property that's we're talking $430,000 to $495,000, right? So if it's $65,000 on a $6.5 million property, it might not be, that'd be a whatever. Not worth noting, but that's a very interesting. That's big. That's over
huge.
What's that percentage? That's chunky anyway. A lot over 10%. And so, why did we get 4 valuations?
So what we did for this client, a lot of our brokers do this as well, is that we will proactively order multiple valuations with suitable lenders. And the reason for that is so we can determine what is the maximum amount of equity we can take out from that property to roll forward into the next one.
So just to clarify, it's before approaching a lender, right? So it's preparing to work out which lender to work with. So for example, you can go and these are desktop valuations. Is that correct? Yeah.
These are full valuations.
Full
actually.
Okay.
Yeah,
so
full
okay. So basically in this context, a number of different entities, Macquarie, CBA, etc., where we went and said, hey, let's get a full valuation done and let's see who thinks this is worth the most. Then we can go with them as the preferred lender because the constraint that we're trying to solve for is capital. That's a fair statement?
Correct. Yeah, correct. So being able to, before doing this, it would be good to check with your broker what lenders would suit your scenario. So you're not just ordering valuations that you can't actually act on. So checking that first and then ordering multiple valuations with those lenders and essentially taking the highest value to realize the highest capital amount.
Yeah. And you know what's really interesting about this? Like desktop valuations have, like a lot of the time they can come back higher, right? And so people can kind of sometimes get this impression that desktops are just overinflated. But in this example here, there was one bank that provided a desktop and a full val, and the desktop was 439 and the full was 470. So in this case, the full valuation was actually significantly better than the desktop valuation. What type of property was this? Was this a single family home or is this a multi?
This is a multi, so this is a duplex. So we've had multiple different valuations, and like even with getting multiple full valuations, it's also good to get multiple desktop valuations as well, just so you have all the cards on the table, and from there you can work with your broker to figure out what's going to be the most advantageous to move forward.
Yeah, nice. And I don't want to oversimplify things a little bit too much, but why is that important? Like, why is it important for people to be able to access more capital sooner? What is that going to do?
Yeah, it's a really good question. So with doing these multiple valuations, it's usually to assess how much equity we can take out to roll forward. And the higher equity amount we can access, it leads into a higher purchase price with the next property. And that will, as a result, with the compounding benefits of property, lead to higher value of compound growth, which will eventually build a client's portfolio quicker. And again, they can just replicate, rinse and repeat that strategy as they go forward as well.
Yeah, it's not necessarily more expensive properties. It's also just more properties. Because, for example, like, in this example here, the difference between the lowest valuation and the highest valuation was $65,000. $65,000 is starting to get pretty close to how much money you'd need to go and buy another house, right? So the difference between those two valuations is, almost enough to cover deposit stamp, depending on the price of the property and all of that kind of stuff. It's almost enough to buy another house. So there's like a whole nother house. Think about it like that. The difference between the highest and lowest valuations is another house. So that's a very interesting way to think about it. And a lot of property investors do get stuck because they don't have clear optics on what they're trying to achieve and all of that kind of stuff. And this actually is really, really interesting because many of the people listening would know that we've built some technology around portfolio planning. You and I actually did an episode on our portfolio planning software, the portfolio growth plans. And what's really interesting about this is understanding how you can move capital more quickly. You can actually start to see a rapid impact on what happens to the rest of the portfolio. And just these really small moves, like one simple move like that, you go, oh, great, it's one extra house. But it might not just be one extra house. That could actually be like 3 or 4 or 5 years less time to get to your goal because of the way things compound over time. So not only is the difference between the highest and lowest valuation one house, the difference between the highest and lowest valuation could be something like, 5 years shaved off the amount of time it's going to take for you to get your goal, which is the kind of optics you're only going to get if you've got a portfolio growth plan, by the way, which is not something that everyone can do. But if you do want to get one, you can reach out to the team and we can have a chat about getting you one as well, because it's a really powerful tool so you can see how these things collapse over time and really start to make a big shift. So I think this is a really, 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 really important one. Any other points you want to make on this?
Yeah, I just wanted to reiterate something that you said, and Andy mentioned this on the podcast that you recorded with him as well. Like with what we're trying to achieve with clients, essentially what we want to do is accumulate as many properties as we can, as quickly as we can, and this can be a really good strategy to help clients being able to achieve that cadence and that momentum to be able to grow out their portfolio quicker. And then, as you mentioned as well, being able to shave off significant amount of time from getting to their target, either cash flow or equity goal as well.
Yeah, love it. Okay, what's next, Jason?
The next thing that I wanted to go through, which is quite interesting, I don't think a lot of people talk about this, is how valuations can be used to help cash flow, manage cash flow in your portfolio as well.
This is for those of you playing at home. We've got a little Google Doc where we've got some notes prepared for this podcast, and Jason's put in this example. And just before I was getting ready for this podcast, and I looked at this example Jason put there, and I'm like, oh, man, this is so sick. I'm really glad that we're talking about this. Talk to me about how valuations can improve cash flow. This is Jedi Ninja shit, by the way.
It's cool, isn't it? Oh, it's really cool. And I've been using my portfolio as, I guess, like as a bit of a test case, and then obviously implementing my learnings with the podcast and also supporting our clients as well. So valuations can actually be used to improve cash flow on your portfolio. And it can be done through a few ways, right? So when you get a loan with a bank, most of our clients, within reason, we ask, like, obviously depends on their circumstance. We try and maximize using the bank's money as much as we can. And when they buy their property, they buy it at a specific LVR. So that could be 80%, 88% LVR, and they get loan terms on that basis. And a lot of people think when using valuations and obviously refining and taking out equity that is a driver. And that is probably the main driver that we see with a lot of our clients. But valuations can also be used to help manage cash flow in your portfolio, which is quite interesting given the current interest rate environment. And so one of the examples that I have in here is just in my own portfolio. So I bought 2 properties about 2 years ago, and they were purchased at a 91% LVR. So the interest rate at the time was 3.69%, which was pretty high given the current interest rates at that time. But now, in the last 2 years, with all the rate rises we've had, that interest rate is sitting at 7.66%. And because the LVR is so high, that is indicative of the interest rate as well, because traditionally that carries higher risk. And as a result, the banks want to have more security and more capital and benefit to them in doing that. So what I was able to do with these properties is I ordered valuations about 2 months ago, and there was actually enough equity in both properties to refinance, not take out any equity, just de-risk that portfolio. So that property has now gone from a 91% LVR to an 80% LVR, which means there's less risk to the bank. And as a result, they offer more favorable lending terms. So the previous loan that I had was 7.66%, pretty high, even for the current environment. And we were able to bring that interest rate down to 6.14%, which for that specific property is a $5,000 per year improvement in the cash flow of that property, which is significant. That's a significant difference. And that could be put into an offset account to get interest, can be put towards another investment property, could be put towards renovations. You just get more control. So I did that over 2 properties.
Talk about the second property set, but that double benefit that you just mentioned there, the offset, is really, really interesting, because it's not just like, oh, I have $5,000 a year more in my back pocket. It's like, no, you're getting $5,000 a year back that you can put in offset, which then it offsets the actual cost of debt. So you're actually saving more than $5,000 a year. To be $5,000 plus the amount that you're saving on having less nominal debt based on your offset. So talk about the second property.
Yeah. So the second property, I did a similar thing. So I was able to bring that down to 80% as well, and improvement in cash flow for that. So drop the interest rate down from 7.6 to 6.79, and a $4,000 per year improvement in cash flow. So just from doing that, was able to create an additional $9,000 per year of additional cash flow in the portfolio.
Dude, that's awesome. The reason that's awesome is because most people think about refinances as a way to take money out, not necessarily, or maybe just to, change lender, maybe get a better rate or whatever. But you specifically refinanced to change your LVR, which then gave you the advantageous position, which I think is really a unique approach that a lot of people could think about, because, in the context of like, maybe there's an extra 10%, if you can find the right lender with the right valuation, you might be able to get a 10% higher valuation. And that could, as you've kind of pointed out, take you from something like a 91% LVR to an 80% LVR, which is going to give you a significant difference in risk profile with the bank, which is going to reduce. It's awesome. Like, I think it's really, really good.
Yeah.
I think it's a really
it's really interesting.
Yeah.
And you can do it 2 ways. You can do it with the existing lender if you want to make things a little bit easier, but obviously there are some benefits in going to external lenders as well. So once again, same approach, get as many valuations as you can so you understand the equity position. And based on that, you can get favorable lending terms. And it might mean bringing the LVR down from 88% to 80% or even 70%. The lower that you go down, the less risk it is to the bank. You're not giving them any extra cash. It's just the position of that property's actually changed now because it's grown in value. And then you get a substantial benefit in having a lower interest rate as a result as well.
Yeah, no, dude, I love that. I also want to talk about refinancing to take the capital out, because I know we sort of just touched on that. We were talking about the comparison in the lending, and maybe that's a whole property's deposit. But I don't think enough people really think about the benefit associated with refinancing equity out of a property. And again, this comes down to valuations, right? Because if you get a favorable valuation, you could take a significantly higher amount of equity out of a property. But people think, oh, that's cool. Like maybe I can refinance and get $100,000 out of the property. They think about the $100,000 and they go, great, a free $100,000. But there's actually a little bit more depth to it than that, which I think is worth us talking about. So with your permission, I'll have a little bit of an opportunity to have a soliloquy here, because let's just say, for the point of the example, let's say that you're taking $100,000 of equity out of a property, and let's just say, for the point of the example, the interest rate is 5%. Okay, so you've increased your debt by 5%, but you've got $100,000. Now, let's just say, for the point of the example, that $100,000 was all the cash you needed to go buy another house, right? So you went and bought this other property. So you've effectively put none of your own capital in, right? But the cost of the capital that you've used is 5%. Now, assuming you've got an 80 or a 90% LVR on that property that you bought, the likelihood of you getting a return on capital of above 5% is pretty bloody good. I think industry averages or kind of standards is roughly a 20% return on capital based on leverage. Our clients, on average, get 67% in the first year, but that's not normal. So if you're not working with Dashdot, maybe 20 to 25% is probably a better measure for you to think about. But even if it was 25% return on capital in the first year, it's like you're spending 5% to get the money and you're making a 25% return on your capital, which is super powerful because you've effectively taken free money and you're making a 20% arbitrage on that capital. You put money in the stock market, you're not going to get 20% return, right? And this is just that's just the arbitrage that you're making on that opportunity, which is pretty wild. And then on that, the cost of the interest, depending on where you've leveraged from and all of that kind of stuff, the cost of the interest is tax deductible, right? So that's a tax deduction. So even that 5% of interest, you get to claim that against your tax, not the whole 5%, but a proportionate amount. So that goes down, which then increases your return profile again. So you might, let's say, be able to write off 2% of that 5%, for example. So then all of a sudden, it's a nominal 3% cost of capital, and all of a sudden your 20% return's gone up to a 22% return. And then on top of that, you're not even paying for the cost of capital because you've got tenants that are going to pay for the cost of capital. So it's basically an infinite return cycle.
Infinite return.
Which is bananas, because a lot of people don't think about it like that. They think about I can take money out of here and I can go plant another tree, rock and roll. And that tree is going to be great. I'm going to enjoy it. But if you actually think about the financial mechanics of it, it's wild, which is specifically why I think real estate's the best asset class for anyone to be invested in. It's great to be diversified or whatever, but I still think that this is the significantly better way to think about things. And again, that comes down to how well you can think about valuations and how you can apply different valuation methods. So that was my soliloquy. Over to you, Jason. What do you think?
Yeah, I think that's awesome, right? Because obviously we have some clients that do contribute consistent cash to their portfolio, but there are some situations where you can just start out with one deposit to buy a property, and within time you can use that deposit, essentially take out the capital that you've put in after a certain period of time if you've bought well, and just continuously keep rolling that forward without actually contributing any additional cash. And I've done that with one of my properties as well. It's absolutely insane, and there's obviously ways to mitigate the cash flow as well that we've spoken about, and we've spoken about on other podcasts as well. I think it's a really good strategy, and a lot of people can get a benefit out of it.
Yeah, 100%. I mean, personally, I've done it. Because we started Dashdot. We didn't have lots of surplus capital and all of that kind of stuff. We pretty much put in $70,000 at the start of our portfolio, and then maybe we've contributed an extra 20 grand or something over the last 4 years, and I've got a reasonable portfolio, right? So it's pretty awesome when you think
100%.
Like that. Okay, anyway, what other tips have we got for people to use valuations? Can we talk about cap rates? When can we use that? Let's talk about multis, cap rates. What else?
Yeah, for sure. So you'd have to know, first of all, if you've got a multi-dwelling property, get some valuations done just to see how the market is assessing those. And one thing that is a pretty useful tip, actually, for the listeners, when you do get valuations on your properties, ask your broker or banker if you can actually have access to the valuation report. A lot of brokers and bankers don't share that. Sometimes you can get access to it, but it will really give you a good understanding of how they've derived the valuation of that property. And sometimes you can even call valuers and ask for their opinion on things you can do to increase the value of the property. And I've seen a lot of people do this, and I've heard a lot of podcasts about people doing this as well. It can be a really good strategy, right? Because they're the ones that are going to be able to they're the ones that are being employed by the bank. They usually work for the bank, not for the borrower, to essentially make sure the bank is getting appropriate understanding of the security that they're going to cover. So getting understanding and feedback from them actually on how the property sits and what you can do is a really good idea. But on the cap rate specifically, what you can do, for example, if say your property is rented out at a certain amount, what you can do is check in with your property manager on things you can do to increase the rent on your properties. And if you're able to do that and get a valuation based on a cap rate, you can actually increase the value of your property. So I have a example about this for one of my properties. So, and I'll go through an example of how a cap rate. Should we go through an example of how a cap rate actually works?
Yes, let's do that.
In practice. Yeah, because it can be quite. I know we've thrown a lot of jargon around here, so
it's
let's just run through the numbers specifically.
People are not used to cap rates or how to think about it. So let's go slow and let's dig into it.
Yep. So, for example, we've got a property that we've bought about 2 years ago. It's a duplex. One dwelling is rented at $340 per week, and the second dwelling is rented at $380 per week. So the total rent for the property is $720. What the valuers will do is they'll get that as a gross rental amount for the entire year. So if that property was fully tenanted for a year, the rental income would be $37,440. And in that area, the market cap, the cap rate, which is the yield, the average yield for that area is about 8%. So they've said an investor would be looking for approximately about 8% return in that area. And as a result, that property has been valued at $468,000.
How do they derive the cap rate? How do they derive the cap rate in the area?
What they would look at is properties that have recently sold in the area and what they're renting for. So they'd look at what similar duplexes have sold for in the area based on that condition as well. So traditionally, if a property is newer, it would have a lower cap rate. If it's not as new, and it depends on the condition of the property as well, they'll derive a cap rate on that basis. But for this property, the cap rate was about 8% based on similar properties that had sold in the area. And as a result, they've valued the property at $468,000.
Yeah, So what's interesting about that is they're looking at, comparables to some degree. I'm trying to work out what the reasonably expected average yield is in that area. So if the yield is higher, so you mentioned like newer properties have lower cap rates. What that more specifically means is that they'll have a lower yield. Yeah, they'll have a lower yield. And properties that have got a higher yield have a higher cap rate. Fair to say. And so there's an arbitrage opportunity there as well where you can try and split you can find properties that are, for example, under rented. So the yield might be low on that property, but just by renting it differently, you can increase the nominal cap rate on that property, right?
Yeah, that's a very common strategy in commercial property, buying properties that are under rented, getting the rents up, and then getting a significant valuation outcome as a result. So definitely something a lot of people can take advantage of.
Yeah. Okay, cool. So continue on with your example. So in this example, you gave like 720 a week, 37,440 for the annual rent, market cap of 8%. How does that 8% translate to a valuation?
So essentially what's happened there is the 8% cap rate would be used against the market value. So they would see at 8%, what would the property be worth to get that result? So how, at the rental income that's been received, how can we get the 8%, and what would the property need to be purchased at to be able to derive that 8%? And in this case, they've put in $468,000. So $468,000 times by 8% will be the gross rental amount for that property.
Yeah, bingo. So that was what I wanted to get to. If someone wants to do the maths on it, it's as simple as taking the annual rent and then dividing it by the cap rate, or depending on how you're doing the maths, right? So if you've got to use a percentage, so if you divide by 8%, then you will get, so 37,440 divided by 8% equals 468,000. Or if you do divided by 0.08, you're also going to get to the same outcome. So 37,440 divided by 0.08 is going to get you to 468,000. So you do divided by the cap rate, that's going to give you the outcome of the valuation you're looking for. So this is really cool because you can use this on commercial properties as well. Like if you see a property that's advertised with cap rate, you can be like, let me do some maths on that. How much rent is coming in? What's the cap rate? Bang, that's it. That's what I should expect to pay.
Yeah, and you can also see what that property is rented for and get another appraisal to see if it is potentially under rented. And if it is, that could be a good opportunity as well.
Yeah, love that. Cool. And so how can people use cap rates to their advantage? We've talked about like how to calculate them and stuff, but how can we use that to our advantage?
So there's a few ways. What I would suggest is, and we've spoken a little bit about this on the previous podcast that I did, but if you've got properties that are getting valued on cap rates, have a look and see what the market rent is, and just make sure when you are doing your lease renewals, you're as close to that market rent as possible. And you can also work with your property manager to see whether there's anything you could do to that property to increase the cap rate, to increase the rent, and that will result in an increase in the cap rate and the evaluation of the property as well.
Yeah. It's interesting, right? Because when you think about adding value to a property, kind of think about it in different ways. Because if it's getting valued based on, typical residential, valuations and stuff, you might choose value adds differently to if the specific outcome was how much can I increase rents, not how much can I increase the perceived value. That actually change the types of things that you would choose to do to add value to the property, which is really, really interesting, because, fundamentally you could actually end up doing the wrong thing where you could make it look nice, but doesn't actually change the rents. And therefore,
100%.
So,
yeah, it would go from like a renovate for equity strategy to a renovate for yield. So you'd be trying to do things to get the rent up as high as possible.
Yeah, bingo. And so, is it possible to kind of drive how lenders might choose this? Like could there be a scenario where you're like, no, I want my house valued on a cap rate basis or something like that? Can you think of any situations where that might have happened?
It's really interesting, hey, because like in some of these areas that we're buying these multi-dwelling properties, there are still some valuers that are valuing them based off comparable sales. And there are some valuers that are valuing them based on cap rates. So what you can do is, if you work, another reason to work with a really good broker, there are some brokers that actually have really good relationships with lenders where they can choose the valuer, which is pretty interesting, right? I don't think this is quite commonly spoken about. But what you can do is if you've had a valuation from a valuer in the past and they've valued the property based on the cap rate and you want a cap rate valuation again, you can ask the broker if there's scope to assign that same valuer to the property. And as a result, you'll get a cap rate valuation and potentially get a more favorable outcome than if that property was just valued on the comparison approach. So
yeah, that's awesome. This is so good. So not only are we unlocking more capital, but we're also unlocking more cash flow in all of this. Are there any other tips or any other things you want to talk about?
I just wanted to share an example, actually, which has been pretty cool. So we purchased a property for a client so this client we've purchased two, before we did this, he'd purchased two properties with us. And essentially, he was waiting to save money to be able to buy the next property. So he was in a savings mode. He was also buying some commercial properties as well. So he was really keen to purchase with us, but he didn't have the capital to be able to move ahead with the purchase. So we got some valuations for him as part of the portfolio health checks that we were doing. And we bought the property for $450,000. And in 9 months, we had a valuation come back at $650,000. So 44% growth. At 165.7% return on invested capital.
In 9 months?
The client was able to essentially, in 9 months.
That's
in 9 months. So when I called the client to give him the news, he was just absolutely mind blown. And the next thing that we did was essentially go back to the broker, refinance, take that equity out, and he's bought two properties with us since and is now purchasing another one in self-managed super fund as well, which is
so
really cool result.
Awesome. Okay, so 9 months went from 450 to 650 in 9 months. Epic. So that's $200,000 uplift, 44.4% growth, 165% return on invested capital, which is wild. Then we refinanced out the equity, well, they did. And how long ago was that? Like how long? Because when did they do the refi? Roughly, you want to have it on hand. But I'm just curious, because you mentioned they've now bought two more properties and about to buy a third. So I'm very interested to know, 9 months to get to the valuation where we took the money out, and then how long to get the extra three properties.
Yeah, so we took the equity out immediately, and then about a few months later, we bought another property, and then the client did the same strategy with the first property that he bought, took the equity out of that to buy the next one. So we've bought two properties using essentially two properties have created two more properties using equity, same thing that we just spoke about earlier. And now he's using his self-managed super fund to grow and purchase the fifth property. So essentially, other than buying those first two properties, there hasn't been any additional capital contributed from his end. He's just used the equity from the first two to buy two more. And then we'll likely replicate that strategy in another 12 to 18 months again. So it's been really interesting.
Unreal. And can I just dig into that a little bit more? So when that that was a duplex that was purchased in Bundaberg. Was that purchased? Was the kind of like seller's valuation based around or like a residential, valuation, and then the quirk is that we've used a cap rate valuation to derive that massive uplift?
Essentially, yeah. And they've also used really interesting comparables as well, because this is a pretty big house that's been converted into 2 separate units. So it could be valued either way. And we got a really favorable valuation. And this is another example. We ordered multiple valuations. This one was the most favorable. The ones secondary to this, I think there was one that was $50,000 lower, and there was one that was $100,000 lower as well. So if we didn't get those additional valuations, we actually wouldn't know that there was an opportunity to be able to do this. So another good case for getting the multiple vals.
Hey, let's talk about a different example, which I don't know if you've prepared any notes on, but let's talk about, there's a couple of examples where we've had clients who have bought like 4-pack unit blocks, for example, but then have either bought them where they've already been started, but bought them on a, commercial lending, but then refinanced them on residential lending. And there's been some advantageous upsides there. Can you talk to that a little bit as well? Because that's another way that different valuations or different criteria that could lead to different valuations and different lending situations can be used to people's advantage.
Yeah, this is a really interesting one that I think we spoke about this a few months ago, actually. So this client we bought when you're buying blocks of units, you can usually get a discount as opposed to buying them individually. So we bought a block of 4 units for one of our clients in Rockhampton. I think we paid about $700,000 for that property. And it was about 6 to 12 months after we got some valuations done on the individual units. So because the property was already strata title, we haven't strata titled these units. We bought them strata title, which means we could get favorable lending as well. So we bought these at 88% LVR, which if they were on one title, that would be quite difficult to do. Traditionally, it would be about 80% if you're lucky. Most of the time, it's about 65, 70%. So we got capital advantage by doing that. And then we had the units valued individually after the property was purchased. And the individual units valued up to an amount, I think it was $300,000 over what we actually bought the property for. So significant equity uplift. And that property is consistently having the rents increased because it's in an area that has quite tightening vacancy rates as well. So really good opportunity there, both from a cash flow perspective, but also from a capital perspective as well.
Yeah, I love that. It's such a good hack. I remember years ago we did something similar with another one of our clients where we bought a pretty decent sized unit block. I think it was a 4-pack, maybe a 6-pack. It was about $850,000. But again, they were all strata titled. And then when you individually valued them, the total asset value was something like north of $1 million. There was like a couple $100,000 just sitting on the table, depending on how you looked at the exact same property. I mean, it's fascinating, really fascinating.
Yeah, 100%. Because the value, they usually derive a higher value when you value the units individually. So it can be a really good case for, buying blocks of units and potentially strata titling them because you get the cash flow benefit, which is quite helpful in the current environment. You also get a significant capital benefit as well.
Indeed. Love that. Jason, this has been really good. Anything else before we wrap it up?
That's it. I think we shared enough hacks.
Lots of hacks, lots of great intel in there. Jason, as always, really enjoyed it. Thanks so much for your time. Can't wait to have you on again.
Thanks, Goose.